We are looking straight at the structural reality of end-of-life budgets for wind farms, specifically the heavy reliance on net recovery offsets.
Right. Looking at the mechanics of the trade, you have operators carrying massive decommissioning costs on their books. To balance that liability, they factor in a salvage value offset, meaning they plan to offset demolition costs by selling the recovered steel and copper.
Okay, let's unpack this. You're likely familiar with the standard narrative here, but the structural fault line is that operators are just taking the physical weight of turbine materials and multiplying it by current reference scrap prices.
What's fascinating here is that this salvage offset is frequently the exact line item making a project's budget look manageable to investors, but that figure is systematically overstated. It creates a massive blind spot across the market.
Because they were just doing basic spreadsheet math,
Yeah.
right? Without factoring in the actual physical logistics.
Exactly. The physical reality doesn't match the spreadsheet. A reference scrap price assumes you have a perfectly separated grade of metal sitting right at the loading dock of a processing mill.
Not a mixed material structure standing hundreds of kilometers away in a rural field.
Understood, yes. Getting that metal to the mill means you have to dismantle the structure, sort the components, cut the steel, and transport it. Each of those physical steps costs serious money, constantly widening the gap between the theoretical price and the actual revenue.
And looking at the drivers of risk here, that gap is especially wide with copper. Copper prices are sky high right now. Even a relatively small volume looks incredible on a balance sheet.
But that copper isn't just sitting neatly in a warehouse. It is wound tightly inside heavy generators. To give you a sense of the mechanics, we are talking about a generator sitting 300 feet in the air.
Right.
Just getting it to the ground requires specialized, incredibly expensive cranes, or look at the underground collection cables.
The ones connecting the grid across the farm.
Exactly. They are buried deep in the soil across the whole footprint of the project. The sheer cost of the heavy machinery and labor needed to dig up miles of cable is often higher than what the extracted copper is actually worth.
So physical reality dictates they just leave them in the ground.
Right. Yet the financial models frequently claim the scrap value of that full, untouched cable inventory. That is a massive asymmetry in information.
Here's where it gets really interesting. What happens to the components that scrapyards don't actually want? The models happily calculate the copper and steel, but they seem to completely ignore the massive composite blades and the fiberglass nacelles.
Which is a critical omission. Those materials carry a severe negative salvage value. You can't just toss a 200-foot composite blade into a standard recycling bin.
Right, you have to break it down.
They have to be cut into pieces on-site with specialized diamond saws, transported on oversized flatbeds, and taken to specific industrial landfills that will actually accept them. That disposal costs a fortune.
So the expense of handling all those non-recyclable components eats directly into whatever margin you scrape together from the metal.
The waste disposal costs actively cannibalize the metal revenues, and standard protections in these financial models fail to consolidate this into one true net figure.
So what does this all mean? The ultimate implication is that the true net recovery is far, far lower than what is carried in these models. When you strip away the math errors and factor in physical logistics, operators are essentially taking an unhedged 20-year gamble on scrap metal prices just to break even.
And the critical variable the market needs to watch next is volume. The entire first-generation fleet of global wind turbines is going to reach its end of life simultaneously over the coming years.
Right.
When that happens, will this unprecedented massive volume of decommissioned steel and copper suddenly flood the scrap market? It is entirely possible that the sheer supply could crash scrap prices exactly when these operators are relying on that revenue the most.